Hello, everyone, and welcome back to Outspoken Market Global. Leandro Guerra speaking, and today's class it's about risk management when trading the spot with the gamma levels. I have been asked in our Discord community, particularly about this subject. So, when doing the trade with these levels that are published daily in om-qs.com, how should we manage it? How much of the account I should allocate per trade? How long should I wait? Where should be the stop loss level? Where should be the take profit? And things like that. Now, to be very honest with you, risk management for retail trading definitely it's not what people think it is. People think that it's like a casino, that eventually you will be willing to risk a special proportion of your account per trade in exchange of gaining a certain amount when you are right. Now, don't get me wrong, mathematically, this makes lots of sense, of course, because the relationship between the winning rate, how much do you win, the loss rate, and how much do you lose, will compound the expected value. And the expected value, of course, should be positive, meaning that in the long run, you are going to make money. That it's absolutely fine. My point is, there is no single rule of risk management that will fit each one of us, each one of the sizes of our accounts, and the strategies themselves. So don't take this type of information as the holy grail or the golden rule of trading of risk management. This is the first consideration. The second consideration is it's not the risk management that will make you profitable, or it's not the absence necessarily of risk management that makes you to have losses. If your strategy it's not good, it does not matter the risk management. If right? You don't have a good strategy, a good quantitative trading system, you can do whatever risk management, you will never be profitable. So people usually blame the lack of risk management as well the main reason for not being successful in trading. While the main reason, and actually the only reason, it's the absence of a good strategy. Now, if you then combine a good strategy with some, let's say, best practices of risk management, naturally you will make your returns even better. So there is no one size fits all in this case, and everybody, every one of us knows where we are willing to take the risk and how much we are willing to take the risk. The general advice that exists before we get into the points of the class, because I mean, people, this is honestly, I'm not a fan of this subject, right? Because it's obvious, but I know the obvious must be said. So why people do leverage? Oh, yes, because leverage will make you make more money and make faster money. Yes, but also it increases the risk. So even a good strategy may fall or fail with leverage. So the first rule, don't leverage unless you know exactly what you are doing. And people, they don't do it. It's like just learning how to drive and then going to drive a Formula One car. Of course, you're going to crash. Of course, you could have been acing your driver's license tests. You are going to crash the F1 car. You must have a career in racing until you are able to drive and have the super license to drive an F1 car. And it's similar to the trading. But people, they already start leveraging. And then, of course, they are going to fail, right? So, that being said, or such considerations being made, this is one of the actual examples and the values that I publish daily on om-qs.com in the research blog. There are, of course, all of these analyses, they are free, on which in this case we have for the SPX, but we also have the triple Q, we have Bitcoin, and etc. But for the SPX daily, we publish the levels of the call and the put walls. And if you have no idea what I'm talking about, here in the channel there are several other videos explaining not just how to trade the spot, but the straddles, trade the gamma levels, or even a step before that is what is a gamma level, what is gamma exposure, what are the options. So we have everything in place here already in the channel. So this is the data for today with the options expiring tomorrow, right? Now, call and put wall at these levels, we have the gamma flip, and then we have the spot by the time of the publication. First thing that you must do, it's identify, are we in a positive GEX environment or in a negative GEX environment? Positive GEX mean that the spot it's above the flip. And in this case, we are on a positive GEX scenario. Why this is important? Because market will react or it will see the levels, the pins as resistance. So we are going to go up, we will reach one of these levels, and then we are going to bounce down. And then if you reach a lower level, being in a positive GEX environment, that it's a support, we are going to bounce back up. If we are in a negative GEX, if the market comes down and then breaks such levels, the movement will accelerate. Volatility regime is different and it's increasing on a negative GEX, while in a positive GEX, we have lower volatility and this type of behavior. So this is the first thing at all that you must do. Once you do it, and then we are taking the example in a situation that we have a positive GEX, this is an illustration about what you can do in terms of risk management, right? So the blue line is the price. Let's say we are naturally here above, right, the gamma flip. So we have the spot at 7259. So we were more or less here in the middle. Assuming that the wall was here and also that we have another pin levels, the expected reaction of the market, since we are in a positive GEX, is that we'll go up, bounce back, and so on. And eventually we'll break the levels naturally because we are going up as the major trend. In this type of the situation, you are gonna wait for a reaction. So we already understood that we should map the levels and the regime we are. You will wait for the reaction in the level. And only then, when you see such rejection in the case of a positive GEX, then you think about entering. And this happens several times daily, every single day. This is also important because in the case that you miss an opportunity, you should not be searching or trying to find another one that eventually does not exist. You can simply wait tomorrow. You don't need to be the Gollum of trading, obsessed on, yes, I must enter daily. You enter when you have to enter. So the price goes up, you wait for that rejection, And usually that happens in the closing of the candle. Usually you can map 1 hour candles, or if you want to be a little bit more aggressive, you can go down to the 15 minutes, but you should not come lower than that if you are trading the gamma exposure, because it makes no sense at all. So you wait for that rejection and then you enter. When do you stop or assume your loss? If the following close, it's not going to be doing what is expected to do, that it's to bounce back in the resistance or eventually in the support if we were coming down. That's it. Oh, yes, Leandro, but this does not answer the question about how much should I risk and what is the size of my position. If you want a number, I can give you a number, and then you play around with that number, remembering always that if you lose half of your account, you need to make 100% to break even or come back to the original level at least, and more than 100 to break even. If you lose 25%, you need to make, I don't know, 33, 30 something to just come back to where you are. So pay attention to that, right? So if you have a consolidated strategy as the gamma exposure, that was naturally, of course, was not invented by me, but people have been doing this already for several years. This kind of a consolidated strategy, eventually you can risk per trade 1 to 5%. So you see, it doesn't matter if I come here and say, yes, risk 2% per trade, 3% per trade, 5% per trade. I have no idea if you have $1 million, $1,000 account. I don't know. And if you are not able to decide that, sorry for the honesty, you shouldn't be trading. You shouldn't be thinking about gamma exposure if you don't know that well, but should I risk 2 or 3? Because actually, there is also another truth, that is, it doesn't matter if it's 2 or 3. I'm an engineer, right? So, I mean, this is too close. Who cares? Of course, 2 or 20%, this matters. But come on, people, 2.5, 3% per trade, it doesn't matter. What matters is I know how the strategy works. I know what I'm doing, and I know that I should wait for the reaction to enter. And if the reaction gets canceled because the price reacted in the other direction, then I close. That will be the place in validation, because you will be seeking for something around that. So let's say we were here, you waited, we have touched the call wall, and then eventually you can see that, look, we have another level. The immediate one above is this one, and it's a pretty decent resistance. That could be the place on which you should stop if you don't get back, or you compound waiting for the rejection again. But remember, you will have this one in between. So you will be somehow stuck here before getting to this upper level. This is what you should observe. And then let's say, not yes, it reacted well, it came back. Where do I take profit? Well, you know where the flip is. In the absence of a lower level, because you see the supports, they are very distant and they are even under the gamma flip. Your target is the flip, because the flip means a change in the regime. So you will also expect the market to react it there, and you don't want to pay the price. And if there is no reaction, there is no trade. And as soon as you touch, you leave, right? And then eventually you can try to check, well, I expect to bounce back. So I will do the same thing again, right? This is what you can do. You can even try to scale into targets in a flip, on a pin, on a positive wall. You can try to even, okay, I will enter here. I will enter another bit over here. And then if all of these levels, they are not respected, I stop and then I move on. And then here I will be having, if I'm total risking 3% of the account, maybe I will enter with a half here, another half over here, and that's it. Because if I lose, I will lose 3% of my account. But then remember, depending on how big it was this distance, you may need to get it right several times in order to break even again. So you must think as well, okay, here we have 100 points, right? Just to make it simple. And here we have 50, or making the actual number from the spot. We got intermediate levels. So here it was 20, and here we had another 30 points. So let's say 50 points. So you can see that, well, I do have some levels. So maybe here I can put that risk proportion. Like, yes, I may be losing 2, and we know that this it's right more than 50% of the time. So the expected value will be in your favor. But you see, people, anything else that I speak about this subject that it's not already what I told you would be just mean being, you see, walking in circles, trying to convince you of something that makes no sense. I know it's not eventually the answer that people would like to hear, because what people would like to hear is, yes, you have a $10,000 account or $1,000 account. You take 200, you enter 100 here, and then you enter another 100. You stop everything if you are above 200 points from the wall that you enter, and then you take profit over here. Hey, it's fine for a $10,000 account. Well, this is 2%, yes, but for 1,000, then this is 20%. You see, so is it reasonable that you place 20%? That is it. That is the case. What matters? What is the key takeaway? The key takeaway is this strategy gives you more than 50% of accuracy long term. This is already good enough. There is no one size fits all. There is not a single rule. So what you should invest time to learn, it's to map the levels, wait for the reaction to enter the trade, and knows when to get out, or when the entry eventually will become not valid. And this happens on these levels because the price simply can escape, because something has happened. And then, well, we know that this it's very dynamic. Market makers are hedging every day, several times in a day. So these will fluctuate. Empirically, we have seen that it's not so dynamic as we may think. So that morning read that we do, it's already good enough to have that level of accuracy. But still, this is the key point, right? This is what you should master. If you master this, then you can take 5% of your account, even 10%. Leandro, fine, got you. What do you do? I don't leverage. Rarely should you say don't. It's maybe too strong because yeah, sometimes I do, especially when the VIX is in under certain conditions, and I like to trade the VIX. On this kind of stuff, right? If I take my account, I don't know, it varies a lot. I already did 5, I already did 10%. What I'm pretty sure is that I never go more than 10%. And then this it's inevitably subjective, but you will get with experience. But then, Leandro, another question yet: how do hedge fund how a fund manager checks this out? Do you really want to know? They go even further than that, more subjective, let's put it that way, than that, because they will be controlling the position and the returns based on the levels, reading dynamically the levels. So they won't be bothering themselves with, oh, the 7,400 of the S&P will stop. No, they work in the levels, and they will manage their sizing and the account based on that. Of course, they may have some numbers, like if we trigger a 5% loss of the account, we stop everything. But these are more major levels. But they don't really go on to this level of scrutiny and say, yes, I have a risk reward of 2 per 1 and things like that. No, the gradient is much bigger and it's wider than we think. And eventually you should pursue the same thing, remembering that, yes, leverage only if you are really, really willing to take the risk, or if you know what to do. Okay. But these are the indications. If you already do this analysis and you can make this reading, literally 1, 2, 3, 5% of your account per trading would get you in a reasonable way. It doesn't matter, right? So, first things first, the execution loop and the strategy are more important, because yes, risk management is not a separated layer, but it's not necessarily what makes you to become profitable if you don't have a good strategy. But if you have, you become more profitable. That is true. Are we clear, my friends? So again, I know not maybe the answer that you would like to hear, because we are conditioned to this gambling approach to the markets. But believe me, if you train that, you will get used to what I'm saying, and then eventually you will get things right. Leandro, you mentioned about the size of account. One last thing, that it's fine. But what about, the sizing itself, right? So this is basic calculation that you do. But something that you can, once you master this, that you can start taking into account to help with the sizing per trade, because not all the trades are the same. So it's true that should we place, I don't know, I decided that I'll go with 5% every time. But not all the time 5% will be the same stuff, because the market will be more or less volatile and your 5% will not be exactly reacting the same way. Then something that you should do is to take into account the volatility. So for this type of stuff, you need the market to be volatile. And the more it is, the better. So you take the realized volatility, and then you can use that as a multiplier to understand how much you can eventually stretch or push a little bit further, right, in order to maximize a little bit your profit. Okay, are we clear? If you still have any questions or doubts, let me know in the comments. Join our Discord community and trade safe. Take care. See you next time. Bye bye.